Hi, thanks for tuning in. I've been just inundated in the last couple of weeks with lots of calls regarding the financial turbulence that we're seeing in the market. I thought it'd be a great idea just to put together a video series on some of the things that I feel are impacting the financial situation. There were two major things that happened in the last week or so. One being that the US government had their debt downgraded after the fiasco that focused around the raising of their debt ceiling. Number two, the central bank in Europe decided to start purchasing Spanish and Italian debt. Now, Italy is the 8th largest country in the world. For the ECB to need to start to look at purchasing Italian debt is a very major move, and I want to explain why and why that may cause market turbulence. So I think the best way to describe it is to maybe help you understand what a bond is. You have to remember that the bond market is 10 times the size of the stock market, and a bond is simply a debt. It's exactly like it's very similar to a mortgage. A mortgage is a debt against a piece of property. A bond is a general debt against maybe revenues or some type of asset. So I want you to think about a situation. If, for example, let's say you have a mortgage today on your house, and your mortgage is for a 5-year term, and 5 years ago when you locked that mortgage in, let's say interest rates were at 3.5% or 4%. I want you to think about what your payments is. So let's say you had a $200,000 mortgage and you had a 5% interest rate on, let's say your payment was $1,000 or $1,500 a month. What do you think would happen to your payment if, when that mortgage matures this year, if someone said to you, look, your interest rate is no longer 5%. As the bank, we're uncomfortable that you're going to be able to pay us back as easily as you have been over the last 5 years. So we think that the interest rate should be 10%. What do you think that's going to do to your payment? Your payment might go from $1,500 to $2,000. So you're going to lose $500 every month of money that you have available to spend. So that means things get cut. You know, trips, car payments, you have to look at your grocery bill yet. These are the things that you have to do when people start to raise the cost of you borrowing money. Well, guess what? That's what's going on in Europe. That's what's going on in Spain, Greece, Ireland. Greece is probably the poster child of that issue. But anyway, now that we're getting into these bigger European countries, the central bank, because banks in general, have been lending money to countries, the country's debt is starting to come due. Some of the various debts that they have are coming due. And now, instead of being able to get away with paying 3 or 4 or 5% interest on those large debts that governments need to fund, building of hospitals, building of roads, that doesn't come out of cash flow. It comes out of borrowing and then is paid back over time. Well, when your interest rate moves from 5% to 10 or 15%, if you're a government, you can imagine what kind of impact that can have on your pension plans, your healthcare system. Major upheaval. So what we're seeing in Europe now is that this economic union that brought together the euro is being called into question, and these central banks are now being asked to bail out, what you will, if the underlying banks, by buying up the bad debt that they have on their books, and then thus being able to help keep interest rates down to the various countries that are involved. This is going to lead to some other issues that I want to cover off in the next few videos. I hope this helps. The long story short is, interest rates in these countries are going up dramatically. It's causing problems. Governments are trying to react to those problems. Thanks for listening.